Good afternoon, everybody. Welcome to another edition of the Raintree Client Webinars. Thanks for joining us today. I know there's some pretty interesting weather out east today. I was talking with someone shortly before this call happened, and there's huge storms in Toronto. So I hope anybody tuning in Toronto is safe and happy today. And looks like Jay's got sun hitting the top of his head there, so I know it's nice where you are. So that's great.
It's actually cloudy, but all is good.
Well, that's what happens when you've got a haircut like that, Jay. You collect every ounce of sun. It's wonderful. Thanks everybody for tuning in. I am here today. My name's Adam Durgis. I'm one of the founding partners of this firm called Raintree Financial. And we're on the line today with Amy Kramer and Jay Simmons, both of the great team at Durum. And today we're going to talk about their industrial REIT. We've been at Raintree, we've been working with the Durum team now for probably almost 5 years, 6 years now, I think. So, you know, long relationship, and it's been a good relationship both ways. We really appreciate the professionalism of the Durum team, and just the way that they carry themselves, and maybe most importantly, the way they treat clients. So I'm really happy to have you on the line today, and everybody tuning in for as far as the clients. We're just glad you're here, and we hope you find today's presentation to be valuable. So just to save a little bit of bandwidth, I'm going to turn my camera off because, well, for two reasons: bandwidth, but also you don't need to see this all day. But we'll encourage Amy and Jay to keep theirs on, and we'll turn it over to you. One last thing before we get started, you will notice on the bottom of your screen, if you move your mouse, you will see that there's a Q&A box. I would strongly encourage you to be interactive on this call. To ask questions using the Q&A function, please use that and not the chat function, because it's a lot easier for me to keep it organized. And we will address questions as they come up. If your question doesn't get addressed right away, just know that it's because we're going to save it for the end of the call for the Q&A section. But if it's something that comes up and I feel needs to be addressed on the spot, I will interrupt Jay and Amy and get it done right away. So with that said, let's get cracking. Looking forward to it, guys.
All right.
Perfect. Thank you so much, Adam, for having us on the call, and thank you to the Raintree team for inviting us and being a great partner with us on this fund. So we are here to present today Durum Industrial REIT. Adam did do a bit of an introduction, but we'll really cover off today why we like the industrial asset class. We'll focus a little bit of our time on what's happening within the industrial real estate sector, dive into a little bit of our business model and how we add value for investors, and then finish it off with a little bit on the investment itself, as well as the risks of the investment. Of course, no investment is complete without its risks, so it's always important for us to review that with you here on the call. Just before we jump in a little bit, a quick introduction to myself. My name is Amy Kramer. I am VP Capital Markets of Durum Capital Inc. I've been with the firm for just about 5 years now, and focused on primarily talking about things like Durum Industrial, as well as our other fund, Bowater and Land Trust. And then, of course, joined today by Managing Director and CEO, Jay Simmons. So Jay, not sure if you want to say anything before we get rolling.
Well, thanks for taking the time to hear us all. I, of course, have been here since day one, and it's a pleasure working with Raintree, and thanks for everyone joining us today.
Perfect. So just before we get in, important to note that this is not an offer or solicitation of securities, rather an informative and educational call around what we do at Durum Industrial REIT. Of course, there are no guaranteed returns, and we will cover off some forward-looking information, including targeted returns. It is important that you speak with your authorized dealing representative if you are looking for additional information, and important to review the offering memorandum. So now that we have that out of the way, let's chat a little bit about what Durum Industrial REIT does. And as far as a business model and business objectives, it is quite simple. We look first to partner with investment partners such as Raintree Financial Solutions in order to raise capital to acquire industrial properties. Once we do acquire those industrial properties, we maintain and operate those properties. and then look to add value through renewals, refinancing, as well as decreasing reliance. And what I mean by that is really growing the portfolio and acquiring additional properties. And then, of course, relationships as well. And then we throw in a couple R's of the rinse and repeat. So renewals, reliance, refinance, and relationships, and then rinse and repeat on this business model, all in order to pay those distributions to our investors. We have been operating Durum Industrial for 3 years now, so started off in January of 2017 with 3 properties identified for acquisition. We've grown over the last 3 years up to 11 properties in total in 9 markets in Western Canada for a total of $67.1 million in total asset value. So over that 3-year time, we have grown quite a bit and looking to continue to grow. So that is why we're continuing to raise capital, is looking to acquire additional properties. And we are happy to announce a bit of a 2020 update. We've recently actually removed conditions on our latest acquisition. So our 12th acquisition for the portfolio, valued at $13.1 million in total asset value, and really adding to that portfolio growth. So we are looking to final close on that property at the end of the month. So we'll chat a little bit more about that acquisition in particular as we give examples of adding value to the portfolio. But just before we do that, I think it's important to take a step back and look at the actual asset class. So having a look at industrial and how it compares to other real estate assets that you might be a little bit more familiar with. And so just to kick that off, wanted to touch on the demand of the industrial asset class. A statistic here, 7% increase in net rents nationally within the industrial sector. But you see that that is a 2019 year-end statistic. So in 2019, industrial did perform very well overall as an asset class. But we hear quite often, and you can make the argument quite easily, that we're in a very different environment today than we were 6 months ago. So how has industrial performed throughout this age of COVID, as we all talk about? And before we touch on that and touch on the statistics, I just want to pause for a second and ask everyone on the call just to think about how many times they've ordered something online during quarantine or during COVID. How many times have you gone on, whether it be your groceries or looking to do a little bit of retail shopping, and you go online on Amazon, you type it in, and something shows up on your doorstep within 24 hours? That's a transaction that we are all very familiar with, but we don't give a lot of thought to the real estate required to make that transaction happen. And that's industrial real estate. It's your warehouses, your logistics, your distribution centers. Again, that all feeds into the demand of the industrial asset class. And that's why, even through the age of COVID, it has been expected, and we continue to see that investor demand for the asset class remains robust. So just keeping that in mind and relating it back to our day-to-day lives and how we interact with our shopping behaviors and consumer behavior and the real estate behind those transactions. The second piece when we talk about why industrial is when we look at returns. And within real estate investing, we do look at returns as it relates to capitalization rates. So across major Canadian cities, we look at industrial as it compares to retail and multifamily. And what you see based on the yellow line there is a generally higher capitalization rate across those major Canadian cities, across these different types of properties. So again, speaking to the generally higher rates of return that are experienced within the industrial sector. Just taking that back again and looking at some historical figures, in 2019, industrial did have the highest returns among real estate asset classes in Canada, according to JLL. So that's demand and returns. And the last two pieces that we really come back to when looking at why industrial is in relation to stability and predictability of the asset type. So when we talk about stability, we generally look at things like vacancies. And so even mapping out vacancies over a 5-year period, what we see is a high point and a low point of vacancy, and that gives you a vacancy variance. So in the industrial sector on the right-hand side of your screen there, what we're seeing is a much lower vacancy variance across major Canadian cities over a 5-year period. So what does that really mean for investors in the fund? Is it speaks to the stability of the asset class and the underlying predictability of the asset class, in that we're able to predict recurring rental revenue over a longer period of time because that vacancy variance is lower. So predictability, stability, demand, and generally higher returns is what has really attracted us to the industrial sector and has allowed us to remain heavily invested within the industrial sector as an asset class where we see significant opportunity. So just bringing these elements back to what we're seeing within the news and a few news articles in recent months. So a few from June, we see from Benefits Canada there, talking about the industrial real estate sector being bolstered through the coronavirus and COVID, the age of COVID. From CBRE, we see that brokers are reporting increased interest for investors in the industrial sector. We're also seeing from JLL. So again, these news reports really highlighting what we've been saying for the last few years as well, is this is a strong asset class, and others continue to flock towards it, and continuing to see those types of investments, for instance, from Lowe's Canada, looking to operate a very large distribution center in the greater Calgary area. So it's an asset class that has a lot of interest and a lot of people paying attention to it. And we're hearing the echoes of the items that we like the asset class, or the reasons we like the asset class, are being echoed in the current environment. Jay, anything to add on the industrial piece before we?
Well, it's the times like this right now that we really that I really enjoy the asset class. We see in a down market like this that this is this is when these assets really shine through. We have large industrial tenants that have big, beautiful balance sheets that can pay rent, and so we're getting a lot less volatility in this space than I think what others will see in various other spots of the economy. So yeah, it's an asset class that I'm very proud to own a big chunk of.
Perfect. And when Jay does say a big chunk, I'm not sure about for those on the call, but we do talk about 12.2 million invested by management, directors, and affiliates. And I know in my world, 12.2 million is a lot of money. So that speaks to the alignment of management and directors in the fund.
Yeah, well, it's a lot of money for all of us as well, and it's an asset class that we feel strongly about, and we're really here trying to get other investors to come along with us so that we can diversify our portfolio and basically just get greater exposure. So yeah, anyway, thanks, Amy.
It's a great segue into talking a little bit more operationally about what we do in order to add value to the fund. So a few examples I wanted to touch on today, one being in regards to key lease renewals. So this is one area that we really focus in, that maintaining and operating of our portfolio is how do we add value through lease renewals. And a great example of this was actually a lease renewal that was coming due at the end of 2019. We were able to successfully secure a 5-year lease extension. And why that matters from an investor standpoint and how we add value from an investor standpoint is through things like these planned rent escalations. So having strong relationships with our tenants and understanding the market and having our finger on the pulse in these different areas, we were able to actually secure these planned rent step ups. So initially actually from $12 per square foot at the end of 2019, that increased to $16.60 in the first year of this lease, and will continue to increase up to $18.60 per square foot through that 5-year term. And why that really matters is it boils down to the underlying asset value. So through this rent escalation, not only does it mean we're receiving higher rent numbers, but it's also increasing the value of that underlying property. So a 10% increase that we saw from the 2018 appraised value to the year-end 2019 appraised value.
Amy, I'd like to add there's a general philosophy that we have when we're buying new assets, that we try to get them in markets and spots that are generally going through a bit of a down cycle. And if we can buy assets at lower prices, below replacement cost, and sign a lease that's long enough so that we can step into another market, that's generally the idea, is ride the coattails of the balance sheet of our tenants, and really just find our way into the window and into another market. These particular assets originally leased out of it, I think it was $23 a foot that they were rented out at when they were built, relatively new assets, and the trust picked them up at a relatively low rent environment. And so there's lots of room for that rent to move upward and provide our investors with more than just the yield that comes on the asset. So we like to be paid to play for the time that we're there, but also have a lot of room for capital appreciation on these assets. Sorry, back to you, Amy.
And I think that's a perfect segue into looking at how we are looking to acquire new acquisitions in this environment. So again, looking for those acquisitions with those strong balance sheets and tenants who can ride out the wave over a longer term lease and bridge us essentially to a different economic climate. So that brings us to our latest acquisition announcement. This is a pending acquisition. We did waive conditions at the beginning of the month and expect to close on this property at the end of July. But $12.8 million in our contracted purchase price. The appraised value on this property was $13.1 million. So acquiring below that appraised value. Again, looking to buy low, sell high is the typical investment philosophy. And an asset that we're quite excited to add to our portfolio. Again, looking at the tenant itself, this is a 10-year lease outstanding on the building with a strong covenant tenant that we gained comfort on from a financial due diligence perspective. So very much looking forward to adding this acquisition to our portfolio and seeing that overall portfolio to continue to grow. And it just speaks to how, again, we're adding value by decreasing reliance. And when we say decrease reliance, we mean decreasing any reliance on a particular property. And we do that by growing the overall portfolio. So an acquisition that we're quite proud of, and we look forward to sharing additional updates on as we look to close on this property.
I can just, one other thing I would add with this particular tenant, we actually tried to land this tenant in one of our other properties that we owned a few years ago, and unfortunately they wanted the latest and greatest brand new perfect building. And so that's actually what is built here now, and the developer has determined that they will sell the building. Anyway, it's an outstanding tenant to have. I can tell you there's well over $100 million of equity sitting behind the balance sheet that we're relying on to pay our rent. It seems crazy to me that we would be able to buy a building at a capitalization rate that high, given the quality of balance sheet that sits there. Of course, we add debt onto that, and the cost of debt is very, very low. And so our return on equity on a project like this is substantial, and locked in for a very long term with 10 years. So back to you, Amy.
Perfect. So that's a bit about industrial itself and about our business model and a few of the ways that we look to add value. But how does this all boil down from an investment perspective? So what do we really look to do first and foremost is to protect unit holder capital. And we do that through participation with experienced and aligned management. So when we talk about experienced and aligned management teams, it's not just about getting the right people in the right seats, but it's about having that skin in the game. So protecting unit holder capital like it's our own, because it is, a large portion of it is our own. So as we mentioned before that, $12.2 million invested by management directors and affiliates. Secondly is exposure to the unique and strong performing asset class. So I think we talked quite a bit about that on the industrial sector and what makes it a bit different. And the third and final piece is potential to benefit from yield and capital growth with that total target return of 8 to 12%. So how that's broken out is 6.5% in the Series C trust units that we're offering, paid as a distribution, plus potential from capital growth with a profit split potential of 70% to investors. And that's what gets you to that total target return of 8 to 12%. Looking historically, we just broke down what we purchased our 11 properties at and compared that to the appraised values we received at the beginning of 2020. And what that shows is a 3.5 million unrealized gain on the portfolio. So why we like to show this is we're only as good as our track record, and what this shows is that our track record indicates that we have made money year over year in terms of adding value to the portfolio and adding value to the properties. Further to that, 16% current annual portfolio return on investment, that is based on a property level, so not at the trust level, but on an individual property level all combined. We have seen that 16% return on invested capital.
It's also invested capital, not equity, and of course we lever those numbers up with the use of low-cost mortgages.
So in this time, we would be remiss if we didn't talk about COVID and the impact that it's had on tenants. Jay did note earlier in the presentation that we have liked the industrial asset class because we do have those strong tenants, strong covenant tenants with those strong balance sheets to support themselves through this time. And we've been very pleased to see that that has been the case. We do have great relationships with our tenants and have been able to have those conversations with them right at the get-go to understand their businesses and how they planned to execute through the time of COVID. And the rent collections you see here on the screen, so we had 94% in April and May and 90% in June. Those actually have been updated based on contracted rents received to date. It's actually closer to 97% as it sits today. So we're very pleased with the rent collections that we have had from our tenants through this time. A lot of their businesses haven't skipped a beat, and those who have been a little bit more concerned, it's been an open conversation to see how can we support you through this time and potentially push rent out to the tail end of their lease. So it's not a transfer of wealth, but rather a working with the tenants through this time. For July as well, we have received 94% of contracted rents to date. So just a bit of an update there from what you see on the slides. As far as the investment itself, so we are offering Series C trust units. They're priced at $100 per investor unit. And as noted, there is the targeted return of 6.5% paid quarterly as a distribution. It's also good to note that we have paid that distribution since inception in accordance with that target. And then of course, the intent to achieve a total target return as stated of 8 to 12%. We do offer a dividend reinvestment plan, and within that DRIP plan, there is an opportunity for a discount through the DRIP, currently set at 2%, subject to change. Keep an eye on your inbox if you are an existing investor. For maximum offering, we are raising a total of $40 million in aggregate proceeds, and the minimum subscription is 5,000 in investor units. It is eligible for exempt plans, and full redemption is available after 4 years. It is always good to review the redemption restrictions with your authorized dealing representative. There is quarterly redemption limits and penalties for early redemption, but that full redemption anticipated and expected after 4 years. Of course, there's risks to any investment. It is important to note that this is not a comprehensive list, but we will chat through a few of the investment industry and issuer risks listed. Of course, there is no guaranteed return, and the unit should be viewed as illiquid, as well as financial performance could be related from COVID-19. So we do look to mitigate these risks, particularly around COVID, and have kept our finger on the pulse in terms of how it's impacting our tenants. So we don't view that as a significant risk at this stage, That being said, it could be a risk in the future, similar to pandemics, infectious diseases, and virus outbreaks. Something that you'll see likely in all offering memorandums going forward as a risk. As far as
I just want to pipe in. There is one thesis around COVID that I think is quite interesting, and I think it's quite probable. Is I think there's going to be a reindustrialization of North America, basically having everything manufactured overseas, and the amount of travel that's happened historically. You know, there's a big push to sort of bring a bunch of manufacturing and that industrial work type home. And then of course we're definitely seeing a big shift towards online. Everything's moved online much faster. So oddly enough, I'm thinking that we may be one of the benefactors of COVID rather than it being something that wipes our business out.
Perfect.
Back to you, Amy.
Yeah, it's a good point to make. So we do see it as an opportunity in some respects, opposed to just a risk. As far as significant capital expenditures, this is one we always like to touch on as well in terms of how we mitigate that risk. And part of what we do when we're looking to acquire properties is get full building condition assessments done on those properties and the real property reports, so that we have a really good understanding of that building envelope and what we can expect from that property in terms of those capital expenditures. So they are budgeted expenses. Of course, when you're dealing with real estate, there could be some unforeseen things that come up, but we do look to mitigate that risk. As far as issuer risk, there is some reliance on key personnel and limited ability to remove trustees or general partner. We do always touch on that just to provide a little bit more detail on why that's a risk. And currently it's a risk because of the large investment of the from the management directors and affiliates. And it's for that reason that there is that limited ability to remove them. That being said, within our governance structure and our governance model, the board of directors and board of trustees has the ability to remove management. So you can rest assured as an investor that management's feet are held to the fire by a very credible board of directors and board of trustees, and they do have the ability to remove management. So I'll pass it off to Jay a little bit to touch on some of these individuals and the team wrapped around Durum Industrial.
Well, I like to think of these guys as having a job that's more than just removing me if I'm not doing my job, but they're great mentors for us is really what I see them as being. I'll run through the background of these guys, but generally nobody shows up to a board meeting ill prepared in our shop. These guys are they're wonderful to work with. They've got great backgrounds. So Joe Lougheed is the is a senior partner at Denton's. It's one of the largest law firms in Canada. He's also chairman of Calgary Economic Development, former chairman of SAIT, former trustee of Queen's University, anyway, and actually former chairman of the Calgary Chamber of Commerce. So really interesting guy there. Grant Sardachuk spent a bunch of his career with Brascan and also ran his own REIT for a chunk of time before retiring. He's largely a philanthropist now, although his family office does have a fairly sizable portfolio of real estate, including some iconic buildings in Calgary. Michael McGee, I got to know him originally when he was with the Workland family office, and then moved out into another spot working in private equity. Been a great resource, longstanding banking related person in the Calgary market. Steve Allen on the board of directors. Steve is he's got a bunch of letters behind his name, which is kind of fun. So he's an FCA, and that's a fellow of the chartered accountant, of those that are chartered accountants. He's a former president of the Institute of Chartered Accountants. And then he's an ICD as well. So that's the Institute of Corporate Directors. Very strong individual to work with. Recently the recipient of the Alberta Order of Excellence. Gary Bentham, he's originally out of KPMG. He's actually same with Steve Allen. They're both have insolvency backgrounds, which we find interesting. Anyways, a CPA, ICD, currently a director of another private equity firm, and I believe he's still on the board of SAIT as well. Also an ICD, ICD, Institute of Corporate Directors. Sean Morgan's the current CFO at the Workland Family Office, and he's a CA-CFA. He's got private equity experience beyond working at the Workland Family Office. And Bill Robinson came out of actually, Bill has been a director of mine for over 20 years now, which is pretty remarkable. And it's a bunch of different entities that he's just ended up being involved in. But originally got to know Bill with a private equity firm that we had called Entex Capital, and the Mannix family were large investors in it. Anyway, Bill served for many years as the CEO of Manvest, which is Fred Mannix's private equity arm, and then later became head of Loram 99, which is the overall Mannix family office. Bill is set on, I don't know how many different boards he's been on, but it's a crazy number of them throughout his career. Entities like Sleep Country Canada, would have been a founding director on that, A&W Canada, Graf Skates. He's a great mentor and just a wonderful, wonderful guy for us to get to work with. And then on the management side, we have Ian Mackay, who's has 30 plus years of experience in real estate. He actually managed a sizable portfolio for a family office out of Toronto. They had he dealt with all of their malls in Western Canada. He's quite excited to leave the mall industry. He used to have 600 tenants, so this is nothing for him. But yeah, just a ton of experience. And prior to working with that firm, TNT it was called. Prior to working with TNT, he was with one of the large brokerage firms. I believe it was Colliers. He was a principal with. Anyway, so a ton of experience there. So great group for us to work with. Back to you, Amy.
Perfect. So what's next? So as we mentioned, we are continuing to raise capital, and what are we looking to do with that capital is quite simple. Continue to maintain and operate our current properties. So again, adding value through things like renewals and refinancing activities, and then really looking to grow and diversify the portfolio of assets. So as we mentioned, we did recently remove conditions on our 12th acquisition in the portfolio, but we have about 6 additional acquisitions in the pipeline. 2 of which we do have letters of intent signed. 1 has a purchase and sale agreement signed. So looking to continue to move those acquisitions forward and really grow that portfolio of assets overall. And then of course, continue to pay our distributions with the intent of achieving that total target return of 8 to 12%. So that's all for us from the formal perspective, but would really love to hear if there's any questions from those on the call.
You bet. Yeah, sorry, I had it on mute. I think you addressed this earlier, but this was asked right off the bat. What's the current net asset value?
Current net asset value of the portfolio is $67.1 million. That will go up to $80 million following closing of the latest acquisition.
And can you go back to that previous page there where you show the price per security?
Yes, I can. It's $100 per investor unit currently.
And okay. So the next question, and this was asked about 10 minutes ago. So I see a 16% return on investment, but what do I see as an investor? What does that represent in terms of net returns to the investor?
So currently net returns to the investor is that 6.5% targeted preferred return per annum as the distribution, and then looking to achieve over the 4-year period, the 8 to 12% total target return. So that 16% from the portfolio perspective, just if you think about the structure of a mutual fund trust, I guess that's one thing we should mention. We are a mutual fund trust structure supported by a limited partnership. So that 16% is within the limited partnership level. That goes to support the returns at the trust level.
Okay. I'll ask both of you this question. What do you feel is the biggest threat to this this investment these days?
Well, we worry. I'll tell you what keeps me up at night is just the caliber of tenants that we have in the organization. It's not the caliber of tenants, but originally when we got this portfolio, I had one tenant that had 36% of our net operating income came from one tenant. And that one tenant did have a lease that would expire within the life of this lease. And so I worry about having a very large tenant decide that they're not going to renew. I have very little worry about the financial capabilities of any of our tenants. There might be a small one in there somewhere that causes me some concern, but yeah, a lease not being extended and having a really large tenant is what stresses me. And so we mitigate that risk by growing the portfolio. And I should be able to answer this because we had a board meeting on it yesterday as we were approving moving forward with another acquisition, or almost approving. I have a little more work to do before the board's going to sign off on it. But the most exposure that we would have to any one particular tenant is probably half of what it would have been at the front end. So yeah, and as we add more and more buildings in, the risk of any one particular tenant shutting down and not renewing a lease, it'll become insignificant. But that's my biggest worry, and that's what we try to do to mitigate it. And then we try to mitigate, I guess, the next piece that I'd be stressed about. If interest rates run, or there's something particularly catastrophic that happens in the economy, like COVID. How does that impact anyone? And so we have our lease expiries spread across a horizon of time. We try to keep any big clusters happening at one point in time, so that if there's a big economic downturn, like right now with COVID, impact the ability for our tenants to pay their rent, but they might not extend a lease. And so fortunately, we don't have any expiries that are happening in this point in time. But so we don't want a bunch of concentration of lease expiries. And then finally, interest rates, if they were to run away on us at some point in time, again, we just don't want a bunch of lease expiries to happen at one particular time. So we're trying to get a portfolio approach on all of those things. So that's what keeps me up at night, and what we're doing, working very hard to mitigate those risks.
Yeah. Okay. Amy, you talked a little bit about the rent collection earlier, but maybe just on top of what Jay just said, just maybe reiterate the percentage of rent that you've been collecting each month through COVID.
Yeah, so I do apologize. The slides aren't updated just based on how our approvals work with slides. So this is a little bit outdated so far. As you see, it has been over 90% as presented here. I touched base with our accounting team this morning, and they said that's actually been closer to 97%.
That's wonderful. Jay, you said something about 10 minutes ago, just about the kind of the shift towards industrial real estate for certain tenants, right? Like some retail tenants that maybe are going to be doing more online and shifting more to the industrial space. I would imagine that through COVID, there will be some industrial tenants that just don't survive for a variety of reasons. Do you have buildings that you'd be able to repurpose towards like a different type of use? And will that potential shift of maybe retail real estate shifting to industrial real estate, is that something that you'll keep in mind when buying future properties to buy things that could be converted to retail distribution?
Yeah, well, every property that we buy, we start with the same question as what do we do with this when it goes dark? Because someday the tenant is going to move out. We just assume that that's going to happen. So what are we going to do with this thing? So we'll have a thesis for every building on what we do when that happens. Although we've had very, very low turnover, that is our starting point. We've spent a ton of time in the past while studying logistics and locations of buildings and what's happening online, and the ability for us to participate more directly in that. And I do think there are some interesting opportunities. We've been, doing some specific studying on one particular property to repurpose it to participate in that space. So I'm not going to steal the thunder from a future presentation that we have on this, but I think there might be some interesting news coming down at some stage of the game. We are paying close attention to all of this stuff, and I'd say we're quite excited about it. So
that's great. Question came up on Amy, you were talking about the distributions for investors. Can you just go again how that distribution is calculated? Like how the split is calculated?
How the split is, 70% profit split to the investor. So that's over and above the regular quarterly distributions. If there's a special distribution that were to be declared by our trustees, 70% of that special distribution would filter down. Did that address the question?
Okay, that's great. Any other questions from those tuning in? Looks like we've got everything addressed. Amy and Jay, thanks again. You two both always do such a great job on these things. I just appreciate the transparency and your time, frankly. So thanks for doing that. And for those clients on the line who chose to invest a little bit of your valuable time today, we're grateful that you chose to do that. So thanks very much. And we'll see everybody soon. I know there's calls scheduled throughout the summer on a variety of different investment theses.
Thanks all. Thanks for having us. Have a great day.
Thanks, Adam. Bye.
Oh, sorry, I just got cut off there. Thanks everybody for tuning in, and have a safe and happy rest of your week. Take care.